Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. And the talking point today, or the talking points today, are the views of Sunil Koul. He's the Asia Pacific strategist at Goldman Sachs and joins us right now on the show. Sunil, great having you. Thanks for taking the time out.
Thank you so much. Glad to be on.
Now, the pleasure is entirely ours. So, Sunil, there seems to be a thesis that the last 30 to 45 or 60 days have seen global investors retreating a little bit from China, maybe not 60 days, but 30 days for sure, that global investors are retreating from China, moving into the other areas of the Asia Pacific region. We're seeing tangible evidence of that when it comes to India too. Now, I remember you writing a note in April, which I'd seen, wherein you had mentioned about how Indian markets are at fair value. Since then, maybe because of these flows, markets have only inched higher. What's your sense around Indian equities currently, therefore?
Neeraj, you're right. We are still positive on Indian equities. When we wrote the note in April, which you are referring to, I think the message we had is, look, for people who are medium-term investors in India, it's time to start accumulating because fundamentals are still decent and you have seen enough adjustment that has happened in terms of this entire India versus sort of China rotation. Fast forward, obviously, India has done well quarter to date. It's been the best performing market actually in the second quarter across the region. So that has worked well. I think two broad reasons. Part of it is flows, which you were sort of referring to, and clearly I think we are seeing some flows or sentiment in China kind of weakening, and India is benefiting from that. But I would say part of it is also fundamentals, because if you look at the higher frequency activity data, that has been sort of firming up, so that is improving in Indian economy. If you look at the 1Q reporting season, we are almost around 90% through that. We should be done by the end of next week there. But the numbers have been better than what people were fearing. So the domestic economy and corporates are doing well. The guidance from the companies has been strong as well. I think for the BSC 200 companies overall, I think we are printing close to 12% year-on-year numbers, more than 20% quarterly numbers. So I think the numbers are coming through. To your question, I would say valuations have gone up again. When we wrote the note, it was at 19 times roughly. Right. It's gone up to 20 times now. So it's not cheap. But I would say if you look at the relative valuations, which is how we sort of look at the overall region, India versus the region, India was trading at 100% premium back in October. That premium is somewhere sort of hovering around at 50 to 60%. So relatively speaking, India still looks okay. And our sense is that as the fundamentals come through, we are still confident about the 17% earnings growth for the full year and another 15% next year, which will drive the Indian equities higher. So still like the equity markets there.
So you're saying that you reckon that while there are some pessimism around this 18% consensus FY24 earnings growth, you are at 17, which is almost 18. So you believe that that growth number will come through, and corporate commentary thus far seems to suggest that you are sanguine about those prospects.
Yeah, that's right. Our numbers are calendar, but it wouldn't be very far off from the fiscal number. So we have a 17% calendar number. So if you look at the first quarter number, as I said, the tracking of the first quarter number as a proportion of the full year number has been a little bit higher than the historical average. So if anything, there could be upward pressure as opposed to downward pressure for our full year numbers. And I would say the difference between us versus consensus, as you said, like 17 versus 18 isn't that much. But the main difference would be that we have already sort of trimmed down, or we are sort of fairly conservative on our top line numbers. So we have already kind of baked in the slowdown from the reopening boost from last year, slowdown in consumption, which we are seeing in the mid-income space. We are already also very conservative in terms of our infotech numbers, in terms of revenue growth there. And so we sort of baked all of that in. Where we are a little bit higher than consensus in terms of margin expectations, where we think margins can kind of improve close to 100 basis points this year and next. And I think that's also coming in through the commentaries in terms of some of the consumer companies which we are seeing there. So we're fairly confident that we can get to the mid-teens earnings growth on the next 2-year basis.
Got it. Since you've moved into India, Sunil, let me try and first dive headlong into India, finish that piece of the conversation. Then I would love to understand from you, how do you see India vis-a-vis the rest of the region? Because you look at the strategy for that whole space. So would you reckon the Indian market's performance for the next 12 months would be a factor of earnings growth? And I'm using the 12 months term carefully because that will also capture the May 24 elections, right? So it's a busy political calendar with an assumption that the RBI is not a big newsmaker, if anything, a newsmaker for the positive side? Would it be earnings-led performance, or could the political calendar kind of play havoc or some upsides to the equity market performance?
Look, I think, as I said, for sure, we think returns for the equity market will be led primarily by underlying earnings. So, as I said, I mean, our fair value for Nifty is 19 times, market is 20 times. So there is a little bit of valuation risk there, maybe 4-5% there. But on a full year basis, as you said, if you get to a mid-teens earnings growth, that will be what will drive markets higher. I think the election comes in terms of what the path for the markets would be. And I take your point. I think the closer we get to the elections, maybe people will want to kind of hold back their allocations a little bit. So there could be a bit of sort of political calendar in there. And obviously that comes in terms of spending as well. I mean, the government has been obviously spending on infra. And so there have been some expectations from the investors that maybe as you get more closer to elections, some of their spending may be cut back. Some of the corporate spending also, or private Capex also might want to just see how the elections pan out. So yeah, I think there could be a little bit of kind of seasonality around the election cycle, but our sense is that on a full year basis, as long as the underlying numbers come through, the market should be higher, close to sort of mid-teen upside for the equity markets.
Got it. Now, what might support this earnings growth? You mentioned about margin improvements, maybe due to raw material costs falling. If indeed rates come off in the calendar itself, then that might also aid. Where is it that you're most constructive? Is it the consensus BFSI, which will draw the maximum earnings, and banks out there? Or are there some other outliers as well?
Banks for sure. So banks is a large part of the earnings recovery thesis there. I think if you look at the current reporting season also, Neeraj, I think the market got into the earnings season thinking that the credit growth expectations were fairly low. People thought that the margins will moderate quite a bit. What we saw is that banks continue to gain market share from NBFCs and other players. And we saw basically, I mean, if you look at the credit growth numbers, they're still very high at 16% or so, right?
Yeah.
And our sense is that margins may soften a little bit, but it'll be much more gradual. And if you look at FY24 margins, you'll be still higher than the pre-COVID levels. And so our sense is that margins may still hold up for the banks, in which case you can still get decent 20% plus profitability over the next couple of years. And if you look at the recent sort of few weeks, we are now seeing consensus numbers for banks getting upgraded, right? So banks will be one part, but I would say a lot of the other domestic cyclical sectors are also contributing to the overall earnings upswing. So, for example, we are pretty positive on the overall manufacturing space, with kind of government continuing to focus on infrastructure. You have the bigger, which is I think medium-term thesis, but you have the bigger kind of the Make in India and the PLI schemes where we are seeing more traction on the ground, and I think that's also sort of contributing there. Cement also plays into the entire kind of the Capex recovery cycle. And then within consumer, as I mentioned, the margin story, it's heartening to see that we are actually seeing volume growth improving for the consumer staple companies. And they're also, it's not that you need the raw material prices to go down materially below from here. There has been enough raw material cost decreases that happened in the last sort of 6 to 9 months, and some of the lagged impact of some of that will start to feed into margins as well. There is obviously commentary about rural turning the corner in terms of management commentaries. If you look at the rural FMCG volumes, they have turned positive after multiple quarters of decline. So I think there are definitely kind of signs wherein the rural economy is also picking up. We should also contribute to the overall earnings. So if you put all of that together, we think both banks, but as well as some of the domestic sector should be contributing to a decent earnings growth overall.
Damage from IT would be minimal. How are you thinking about that pocket?
Yeah, so I think that the drag on the earnings so far has been, or the disappointments have been sort of two pockets. One is sort of the broader commodity cyclical space, notably the metals. I think they continue to be obviously provide a drag to the overall YOY growth numbers, which is baked in. But also I think as has been our expectation, the broader export segment, which is both IT and pharma, continue to be softer in terms of the numbers, including in this quarter. And so we have been lucky to be on the underweight side in terms of our allocations, because our sense is that the numbers there are still a little bit more optimistic, and there could be kind of more downside pressure on the earnings there. So I think allocation wise, it's domestic cyclicals versus kind of global cyclicals, to put it kind of more in a thematic bucket. So anything that's kind of much more sensitive externally, which will include both IT and pharma, we are a little bit more cautious on there. Got it.
Okay. One one small question, which is pockets which are, and I see diverse opinion there. So I would love to understand from you, because you look at the region. There's a lot of talk around how export-oriented themes may not necessarily do well in light of the fact that the West is undergoing a slowdown. At the same time, from an equity watcher's perspective, there is an argument that a lot of it is captured in the valuations by virtue of the sideways to the downward movement that we've seen in a bunch of these spaces: pharma, specialty chemicals, even smaller pockets like textiles. I'm just trying to understand. I mean, IT, non-IT services, I meant.
Yeah.
Which side of the table are you on when it comes to this argument?
Yeah, I think I'm glad you asked. I mean, there are a couple of ways to kind of look at it. One, I think if you just looked at the overall export data, and it's as is well understood, I think the services exports has been holding up pretty well in India. I think that's a positive story for India, which is obviously helping the overall current account, right, together with the remittances. So on a broader macro point, we're actually quite optimistic on the current account side. We think we could have close to 1.5% current account deficit for this year, compared to sort of 2.5%, for example, last year. So, and part of that story is the strong services exports. The reason I mentioned that is because we have also been noticing that there has been a decoupling from the services exports and the revenues of the top 4 or 5 IT companies. So which basically tells you that there are many sort of, whether it's GCC or whether it's business services, whether it's sort of cloud and all of that, there are sort of, and some of them may not be even in the listed space, that there are many sort of sub pockets beyond the top 4 or 5 IT companies which are still doing fairly good, which is kind of helping overall macro and overall kind of services exports numbers, right? So I would sort of therefore differentiate between the two. So I think the macro therefore looks still decent. In fact, I think we think the stable macro in terms of RBI pausing here, we don't anticipate any further rate hikes for the rest of the year. So from a rate hiking perspective, as well as the current account dynamics I mentioned, the macro kind of looks very stable, which I think provides a very good sort of backdrop for overall sort of medium-term growth for India. But then for the IT companies specifically, I think there you may continue to see some pressure, as well as some of the pharma companies. But I think with pharma companies, we're also worried, at least for the large drug manufacturers, that there may be a little bit of regulatory risk as well in terms of FDA warnings and all, right? The way we are therefore positioned in that part of the pocket of the market is that we again like the companies which are much more domestically oriented than externally oriented. So there are some companies which have a much higher proportion of their revenues coming in from the domestic healthcare businesses. And obviously within the broader pharma space, we like the hospitals as an example, right? So I think within the broader sectors also, which are more geared externally, you need to see which pockets are more geared towards domestic economy versus external economy. So that would still mean hospitals may do better. Some of the domestic drug manufacturers may do better as opposed to kind of external large drug manufacturers there.
Got it. One final micro question before I turn to the region and the macro. I would love to understand some macro and how you're thinking about it. But one final micro question. A combination of what is it that your global clients want to do when it comes to investing in manufacturing in India, Capex manufacturing as the case may be, and where is it that maybe based on past cycles and relative valuations or otherwise, are there themes which are still looking attractive? Because frankly, Sunil, when I look at, again, two arguments. One argument is that if you look at the, cap good majors, most of them are priced rich. But then the argument is that they've always been rich. And when you look at 2000 to 2008, the EBITDA jump was so stark that they will not look as expensive if you look at FY25, FY26 earnings. So I'd love to understand, how are you thinking about it? And where is it that your global clients are wanting to put in money when it comes to India manufacturing / Capex?
No, absolutely. I think we are on the same camp there, Neeraj, in terms of thinking that, look, in the near term, some of these names have run up. And we actually did a fairly detailed work together with our micro colleagues in terms of the broader Make in India theme as well. And I think that the conclusion was obviously across sectors, there are some sectors who are more ready, wherein you are probably able to see meaningful improvement in the numbers in the next 2 to 3 years. There are other sectors wherein you need sort of some handholding from the global companies, some technology transfer, some sectors which are more Capex intensive. So they may take more time in terms of numbers to show up. But I think it's very clear that things are moving on the ground in terms of getting traction. A lot of the PLI related sectors are already seeing sort of activities. Some of them have already started getting money in terms of tranches from subsidies from the government. So our sense is that, as you correctly pointed out, in some cases, when you look at 2 to 3 year out, you will start to see this showing up in the earnings. And so if you look at the multiples on an adjusted basis, things will start to look much more attractive. So I think in the near term, I agree, some of these have run up, but I think for many clients who are kind of looking at India as a more medium-term story, some of this is getting traction. And again, I think when you talk to clients, there are a subset of clients who are kind of much more fast money and who probably care more about the near-term allocations and quarterly allocations, but there is enough pool of capitals, whether it's sovereign wealth, whether it's kind of other global pool of capital, who are kind of looking at India on a more medium-term basis. And I think the conversations we are having with them is how to kind of deploy capital in India on a more 2 to 3 year basis, and where could you find sort of opportunity. And they are very keen to kind of raise exposure in some of these sectors.
Is there newer money coming to India? Is there India dedicated money as well opening up? Because there is always this constant chatter that I hear that at some point of time, India will stop being, ex-Japan EM, but have India dedicated money. So I'm just trying to understand from you.
We are hearing some of that, especially I think from clients based in US or some more global clients. So people talking about sort of India, as you said, dedicated India allocation or India only sort of allocations. I think some of the clients we talk to who are more regional in nature or EM in nature, I think again, it becomes what's the outlook for the rest of the market. And I think as you started at the beginning of your conversation, the fact that sentiment in China, for example, hasn't been as great. I mean, the market did very well in January, but then obviously has eroded or erased most of those gains. And so there is a fair bit of, people are sort of losing a bit of patience on that. And so clearly you're seeing some rotation within the EM mandates in terms of people sort of moving back allocations to some of the South Asian markets, including India. So I think some of the regional allocations are also happening, but there is clearly some global money, which is traditionally not been in India, want to include exposure to India, but also kind of thinking of as India standalone strategies as well.
Okay. Sunil, India relative to the rest of the region, what is your own view? I mean, I know you're constructive India. You've made it amply clear in the last 15 minutes, but relative to the rest of the region, what is your own view?
So fourth quarter of last year and coming into the year, first quarter, we were a bit sort of cautious on India on a tactical basis. And I think the reason for there was India actually had been doing pretty well in the last couple of years, had been a strong outperformer within the EM. And so we thought, and it was sitting, as we discussed, at very high valuations, not just in absolute terms, but also related to the rest of the EM complex. And so our sense was, look, I mean, the fundamentals are still decent, but A, it has done very well in the last couple of years. B, valuations are high. And C, we were expecting rotation to happen from South Asia to North Asia. And obviously China reopening was a catalyst back then. And we also were expecting some upturn in the memory cycle, which plays into some of the other markets like Korea and Taiwan. Fast forward, I think those views actually played out pretty decently. If you look at the first quarter, China, Korea, Taiwan, they were the best performing markets. Even year to date, if you look at the markets, it's basically Korea, Taiwan, Japan has been the outperformer, right? Then we came into second quarter, which is we mentioned about the April report. Our sense was that a large part of that adjustment seems to have already happened, and therefore, when you start to get into the current period, we think it's not as differentiated in terms of South Asia versus North Asia. You may start to see opportunities in both sets of the markets because large adjustments have already happened. So we're still sort of constructive on markets like Korea as an example, which is more to do with the memory cycle there and the fact that we are expecting an upgrade or MSCI putting them on watch list for DM upgrade. So that's kind of a near-term catalyst for the market. But at the same time, as I said, we also constructive on India as a medium-term market based on the strong fundamentals there. So I think it's not sort of North versus South or India versus China at this moment. I think that was pretty much the case from last fourth quarter and first quarter coming into the year. But I think from now on, the markets will be higher based on the underlying fundamentals, and the fact that India's fundamentals still looks pretty strong. It has been actually improving in the recent months, makes us constructive on the markets.
Yeah, I would guess the Korean bullishness would also stem from the fact that the market has virtually done nothing, right? It's actually been a rank underperformer, if I'm not wrong.
This year it has done well. A large part of that performance came in the first quarter. But I think for Korean market to do well, it's a very deep cyclical market in general. So there are pockets of the market which are linked to the global cycle, including US. But it's also a large part of the market is tech hardware and semiconductors. So I think what the investors are looking at is when do you start to see inflection in the memory cycle. And our sense is that we are probably close to the bottom there, which is why the market tends to be forward-looking. So market has been started to firm up there as well in the last few weeks.
Got it. Sunil, just wondering, do you find any thematic risks for any of the regions that you cover in that there's a lot of talk about disruptive technology coming in and hitting a bunch of sectors? Now, some countries may not have the presence of these disruptive technologies. Some countries might have presence of sectors which might get disrupted by these as well. So have you guys done some work? It could be work in progress maybe, but have you guys done some work around what could happen to any of those areas or markets that you cover? Does India stand to gain or get impacted negatively by virtue of all this?
I would say, obviously, I think in the current conversations, there are sort of risks that come up, right? A lot of the risks are either in the disruptive camp, as you mentioned, but also some of the cyclical risks many clients are sort of pointing out, right? I mean, one of the obvious one, for example, would be the external risk to India, right? What happens to the global economy? Are we having a recession or not? By the way, our view is that recession is not our base case, but that comes up in client conversations. A lot of the clients in the region are also worried that if you have a pullback in the US equity markets, how do the region perform, including in India, right? And it could be because the breadth of the market is very narrow. It could be because of the debt ceiling issue. It could be because of the recession issue. But whichever be the reason, one of the questions which keeps on coming is, what if you have a pullback in the US equity market? And I think if you look at historical precedents, it's very clear that every time you have a correction in the US equity market, all the Asian markets actually also go down in absolute terms. Where you can make an argument is that you could see a relative outperformance because you have a stronger earnings growth backdrop. You are at a relatively cheaper valuation in many parts of the region compared to US, and so you may relatively outperform. But I think that also remains a cyclical risk. As opposed to the disruptive technologies, including, I think AI obviously comes up in a lot of conversations, but I think that the conversation more is centered around which pockets of the markets are more levered to these themes and therefore could benefit more, as opposed to whether it is having an immediate near-term adverse impact on some of the other markets.
Got it. Okay. Final question. Any aside of the obvious risks, which almost everybody talk about in consensus, is there something else that you fear, and you might be a minority there, but you fear or you are looking forward to, as the case may be it global or local in nature, which might have an impact on India or the Asian market region?
Yeah, I think one of the cyclical, look, I think, as I said, the domestic macro in India looks very stable to us, both in terms of RBI cycle, in terms of the current account dynamics. Obviously, external risk is something we are mindful of, and we talked about recession before that. But I think one thing which we should keep in mind is that market has become a little bit too optimistic in terms of entire rate cuts, which obviously in US the market is already pricing in some of that. So I think there is a risk that if it turns out that the Fed stays on hold, which is our expectation as well, the market may need to reprice some of that. So which means in the near term you might see sort of rates moving higher. Obviously, in India, it's a different case with the $2,000 denomination taken out of circulation, which is obviously putting some downward pressure on or easing of rates. But I'm saying from a global side of things, you could see some upward pressure on rates, which also puts upward pressure on dollar if market needs to reprice that. And technically speaking, if you sort of go back in history, every time you have a strong dollar environment, that tends to be not as conducive for capital flows, and that I think could be a risk we need to be mindful of so far.
And thank you for putting that into perspective. Sunil, this was lovely talking to you. That this is the first time that we've had you on BQ Prime, and it was lovely talking to you. Thank you for taking the time out, and look forward to have you more often on the platform.
Thank you so much, Neeraj. Great speaking to you.
The pleasure was ours. Viewers, thanks for tuning in.